Welcome to Book Summary Hub, where we bring you the best in book summaries and takeaways. In this video, we'll be giving you a rundown of The Intelligent Investor and highlighting 5 practical takeaways that you can use in your own life. Plus, we've got some important links in the description that you won't want to miss. So make sure to stick around until the end, and let's get started. The Intelligent Investor, first published in 1949, is a classic book on value investing written by Benjamin Graham. It's a must-read for anyone looking to learn how to invest in the stock market. In the book, Graham explains that the key to successful investing is to focus on the intrinsic value of a business, rather than on its stock price or market trends. To determine intrinsic value, Graham recommends using a combination of financial analysis and qualitative research. This means looking at a company's financial statements, such as its income and balance sheets, as well as considering factors such as the company's management and competitive position. He uses the example of a company that produces widgets, which has a strong market position and a history of steady earnings. According to Graham, this company would be considered a good investment, even if its stock price is currently low. Graham also emphasizes the importance of diversification. Graham suggests that investors should not put all their eggs in one basket. Instead, they should diversify across different sectors, industries and even asset classes such as stocks and bonds. This way, if one stock underperforms, the overall portfolio will not be affected as much. He uses the example of a person who invests all their money in one stock and loses everything when that company goes bankrupt. By contrast, an intelligent investor would diversify their portfolio across different sectors, industries, and asset classes to limit the risk of any one stock tanking. In the book, Graham introduces the concept of Mr. Market, a personification of the stock market that illustrates how market's irrationality can lead to opportunities for the rational investor. According to Graham, Mr. Market is often overcome by fear and greed, leading him to overvalue or undervalue a stock. The intelligent investor should be able to take advantage of this by buying when the market is down and selling when it is up. He uses the example of a stock that is selling for $80 one day and $40 the next. According to Graham, Mr. Market is acting irrationally, and an intelligent investor should be able to take advantage of this by buying when the market is down and selling when it is up. The book also talks about different types of investors: defensive and enterprising investors. Defensive investor, who is risk-averse, primarily invests in high-quality, blue-chip stocks and bonds, and does not attempt to time the market or make speculative investments and focuses on steady, reliable stocks, such as blue-chip companies with a long history of paying dividends. An enterprising investor, on the other hand, is more willing to take risks in order to achieve higher returns, and might invest in smaller, less established companies. Finally, Graham stresses the importance of a margin of safety, the difference between the intrinsic value of a stock and its market price. The intelligent investor should always aim to buy stocks at a significant discount to intrinsic value, in order to provide a buffer against market fluctuations and unforeseen events. He uses the example of a company that is worth $100, but is currently selling for $80. An intelligent investor would see this as an opportunity to buy the stock at a discount to its intrinsic value. If you're enjoying this video and want to see more content like this, don't forget to hit that like button and subscribe to our channel. Your support can change the lives of 20 kids. Help us get to our goal of 2,000 subscribers. Now, let's get back to the video. Here are 5 practical takeaways. 1. Embrace value investing. One of the key themes of the book is the concept of value investing, which is the process of investing in stocks that are undervalued by the market. By focusing on finding undervalued stocks and investing in companies with strong fundamentals and good management, investors can achieve long-term returns that are higher than the market average. 2. Have a long-term perspective. Graham stresses the importance of having a long-term perspective when investing. He argues that investors should focus on building a diversified portfolio of high-quality stocks and bonds, and avoid getting caught up in short-term market fluctuations. By maintaining a long-term perspective, investors can avoid making impulsive decisions based on emotions like fear or greed. 3. Understand the difference between investment and speculation. Graham makes a clear distinction between investment and speculation. Investment is a long-term process of buying securities with the goal of earning a return over the long term, while speculation is the process of buying securities with the hope of selling them at a profit in the short term. By understanding the difference, investors can avoid speculative investments and instead focus on building a portfolio of high-quality investments that will generate long-term returns. 4. Evaluate company management. Another key takeaway from the book is the importance of evaluating company management. Graham explains that it's essential to assess whether a company's management is acting in the best interests of shareholders, whether they have a track record of success, and whether they are transparent and honest in their reporting. By evaluating company management, investors can identify red flags and avoid companies that are poorly run. 5. Seek professional advice. Finally, Graham stresses the importance of seeking out professional advice when making investment decisions. He advises investors to be skeptical of anyone who promises easy and quick returns, and to look for advisors who have a solid track record of success and who are transparent and honest in their dealings. He also provides guidance on how to evaluate and select a financial advisor, and on the different types of investment advice that are available. By following these takeaways, investors will be able to approach investment with a clear and rational mindset, as well as a long-term vision and a disciplined strategy that can help them achieve their financial goals.